Good morning, Peter Rose, Longwood Currency Trading. It's the 28th, I think now, of December, and I'll be getting this video out, final one for the year. I kind of wanted to close off, not a series of videos that I've done, but they all seem to have the same flavor to them, and there's been a lot of interest in the folks that contact me via email and stuff as to, geez, I really like that video, and can you talk a little bit more about them? The topic of this video is Forex position risk management. Now, in the past, I did a blog post. I'm reading this off my screen here. 3 Forex scalping position management rules. And then I did 3 videos. The first one was close trades when price momentum changes. Another video, position management is the most difficult Forex trading phase. And another video, Forex profit target position management. That last one, Forex profit target position management, deals with the position management moving toward the profit target area. And what I want to talk about, and taking that profit, what I want to talk about now is the risk management side of the position management. Now, you'd think they'd be both the same, and they really are, but they are different mental events that you're looking at. In the Forex profit target position management, the focus of the video was on the profit target. I'm trying to get to the profit target. I'm trying to get there, and if it doesn't seem to be getting there, then I get out. But the emphasis is on the profit, letting the profit run and managing a profitable position. So what I want to do in this video is sort of take the opposite of that and look at the risk side of it. Well, we looked at the risk side of it. I mean, the profit is running, and when it doesn't run anymore, you cut it loose. It's like the joke I've told before. What do you call a dog with no legs? You don't bother because he ain't going to come anyway, right? So, you're dealing with position management from the profit target side. What are you going to talk about? I set a 20 pip profit target or 200 pip profit target, whatever that happens to be. And when it hits it, I get out. And if it doesn't look like it's going to hit it, I get out. Risk management is basically saying the same thing, except you're looking at the position through a different lens. The first one, Forex profit target position management, is looking at the position through the lens of profit target. And so in this video, Forex position risk management, we're going to look at the position through the lens of risk. Got my coffee, so let's go. I've alluded a lot in these videos that I mentioned, and quite a few videos, is that my risk management. Let's back up a little bit. There's 2 parts of risk management. One is the risk management trade entry risk management, and then there's position risk management. So I've talked ad nauseum about eliminating trade entry risk management analysis from my trading realm. I'm a day trader. I'm trading on a 5-minute chart with an ATR of 5 pips. I set an 8 pip hard stop, and I just let that fucker run if it's going to get in profit, and it goes out if it doesn't get in profit. Now, so we talked about the profit end of that. The risk management side of the position is once the position goes into profit, do you leave your stop at that original place, wherever the hell you left it, 200 pips below entry point, or like I do at 8 pips below entry point? Well, if you're a long-term trader, you might leave it there until the position is in profit a quarter of the way to the target. In the Richard Dennis Turtle Trader program, when the position would turn 2 ATR against them, they'd get out. Well, they were trading on a weekly chart, so 2 ATR is a shithouse full of loss. So, you know, there were a tremendous amount of losses, but when those guys hit the money and they were adding 4 lots at a crack to a maximum of 16 lots staging into these positions, and when they would run, man, they just made a shithouse full of money. That system, and even Richard Dennis says today that that particular methodology is not going to be applicable today because markets were more trend-oriented back then. Doesn't matter the market, but they were more trend-oriented back then where you could do that kind of long-term trading. Today the markets have changed because there are so many more people that are involved in it with different motivations for their trading and different client requirements, for example, in the currency markets, for example. Because that's all dealt with. 85% of the volume is the institutional trader who's satisfying client orders. So that changes your view a little bit of what a trend is and how that goes, because you have so many players in there that are creating these shorter term trends in order to quickly reverse them, take the retail traders out to accumulate inventory, and then progress on ahead for their client so that you have more activity in it. I mean, Jesus, the currency market is $6.6 trillion a day. So things are going to change, of course. The process of trading hasn't changed if you know how to trade. If you're trading under a system, stupid crossover, moving average crossover system, or Bollinger Bands, or fucking patterns, or trend following, rigorous trend following stuff, you're gonna get cut up pretty bad. Trading is trading. So whether you're trading stocks, commodities, currencies, used tires, doesn't make any difference. It's trading, right? It's just the retail trader who tends to put all these systems and structure in place that then it fails to work because they say the market changes. The market itself doesn't change. Price action may change, but it changes all the time anyway to suit the particular economic needs of what's going on at that particular time. So, and the more economic activity you have, the more of that change you're going to have. So if you're a systems trader, you're basically screwed as we move forward. You have to know how to trade, and you have to know the economics of what's going on. Knowing how to trade is always the intention or the implication of knowing how to trade is knowing how to get these big profits. And my position has always been getting the big profits is very problematic because you have all these retracements in price that are going on all the time. How do you know that a reverse price movement is a simple retracement, a major retracement, a swing point, or a complete reversal of the trend? How do you know that? So if you're a long-term trader and you've got a 100 pip stop, I'm sorry, but that's $1,000 a lot. Do you really want to lose $1,000 a lot? I don't know. That's $6,000 if you lose the statistical 6 trades in a row. If you had a $10,000 account so that you could trade a lot, full lot, in the U.S., the margin right now at pound dollar is like $700, $680 or $670, or I mean $6,700 out of the 10. That leaves you less than $4,000 of wiggle room. 4 losses, and you're fucking gone at 100 pip loss. So I take 8 pip losses. Jesus, I could lose 100 of those. Yeah, well, I couldn't quite lose 100 of them. But yeah, you get the story. I could lose a lot in comparison to what the longer term trader is doing with the same bank size, and I'd be okay. So the criteria here is, okay, we take care of the trade entry loss, put an 8 pip stop. Look, if you're wrong, you're wrong. If it turns around, you can always go back in. But I'd rather go back in after an 8 pip loss than I would after an 80 pip loss, really. But once that price is moving, how do I manage that from a risk standpoint, not a profit standpoint? Managing from a profit standpoint would imply maybe peeling off lots, staging out lots as the price moves forward. So what are you doing from a risk management standpoint? Well, you could look at the peeling off of lots as part of your risk management strategy. So look, it goes up 5 pips, I peel a lot off. It goes up 10 pips, I peel another one off. It goes up 15 pips, I peel another one off. So I'm 3 peels down on my 5 track and let the other 2 run. And I've guaranteed myself, and then I bring my stop up, and I've guaranteed myself an average of 10 pips over the 3 lots, 30 pip gain, and let the other 2 run to whatever they're going to run. So that staging out becomes part of your risk management. But if you want to talk about pure risk management, then you have to look at whatever the price is, wherever it is, regardless of whether you've staged lots out or whatever. You've got an open position, and you're letting that run. When do you get out of that? Obviously, if you're letting the position, let's say in my case, I have a profit target of 20 pips. I'm hoping to get 13 out of the whole position. And sometimes I'll stage out. I'm just going to be starting the staging out process as something that my friend Langers, the scruffy trader, does all the time. And I look at what he's doing. I'm going to say, I've got enough real estate in 20 or 25 pips of potential profit target to stage out a few and lock a profit in. Because look, if I make 5 pips, regardless of my bank size, that's a 0.5% of my bank size. 5 pips on a $1,000 bank, a mint trading a mini, is a $5, and that's a 0.5% of the $1,000. If it's $100,000, 5 pips is still going to be a 0.5% of a $100,000 account, trading 10 lots. So I'm happy with a 0.5% when I trade. If I could average that out over 4 days a week, some days I'll get 2%. Some days I'll lose 8%. But averaged out, if you could just grab a 0.5%, 4 days, that's 2% a week, 8% a month. You're talking 80% a year on your money. Can you do that? Retail traders can, I think, because we're not dealing with a $200 million order or a $2 billion order. We're trying to dribble into the market. I mean, even if you're taking in a 10 lot trade, $100,000 order, that's nothing. In a $6.6 trillion a day market, you could probably do, in a liquid market, a 100 lot trade, $1 million. You'd probably do a 100 lot trade and probably not chew yourself up too much in a Euro USD, pound dollar, dollar yen, something like that. So most of the dollar denominated, all the major currencies pairs are generally dollar denominated. Sorry. So I mean that's a lot. I mean, and all you got to do is get a 0.5%, and you're making a shit house full of money. So, but as you lock that profit in, that's great. You've profited on the target, but you've got a running position. When are you going to get out? You don't have a profit target anymore. You're in new ground. You look at the structural analysis. Jesus, you could go back onto a weekly chart, and you may not have a structural mark of a previous institutional trader's campaign to satisfy their client orders. You may not have any of those structural marks back there. You may be like the Star Trek video, to go where no man's gone before, So when do you get out? You just say, well, I'll let it run 500 pips, You have nothing to base that on. You don't know whether it's got the magic pixie dust juju to get up there 500 pips. What is your criteria to get out at that point? That's the risk position management characteristic that I want to make you aware of, that as a trader, you won't have the opportunity that many times to get in a situation where you have that runner going, and you better know what to do with it so that you can maximize that profit. Because most of the really big institutional traders, hedge fund guys, or large traders, Soros or Paul Tudor Jones, or I can't think of any of the other names. You can look at any of the guys in Schwager's book, The Market Wizards, and they'll all tell you that probably 80% of their yearly profits come from 4% of their trades, or 4 trades, because they let them run. They're just in there, they're dealing with so much money, they're just dribbling the money in and dribbling the money in, and when they finally get one of these positions that's just ripping, they go, and that's where they make it. But that's how they have to trade as a hedge fund. As retail traders, we don't have to trade like that. We could drop a 100-lot order in there and let that thing run and pull out at any time, and you might lose 3, 4, 5 pips on the pull, but I don't know, if you're in a liquid market and it's really ripping, that's when you want to get out. Jesse Livermore's process on a runner was, when you got to that blow-off stage, that stage where it just goes, just that exponential blow-off, that's where he'd sell out his position. But he did that. That's not necessarily what we should do as a retail trader, trading a 3-lot or something like that, or a couple of minis, because blow-offs, you don't know when that blow-off is going to end. I forget who it was. It said, was it Keynes that said markets can remain irrational longer than you can remain solvent. So you're a short position and you get a blow-off going, and you think, well, the blow-off can't go on, so I'll keep adding to my short, because at some point this thing is going to come flying down. Yeah, it's going to come flying down at some point, but you don't know what that point is. So if you're a big trader with $2 billion or something like that in the market, with thousands of lots at stake, when that inflection point begins, that's when you start offloading your inventory. You have to unload that. Livermore said that's the only way you keep from chopping yourself up, chewing yourself up, trading against yourself. But again, in those of us that are retail traders, we're only 15% of that $6.6 trillion market. So we don't have to worry about getting out in the blow-off if we're watching that price and have some criteria for what amount of retracement or chatter that I talk about, what that's going to constitute to generate in our mind a take profit. Now, to say you're going to trail your stop behind price in a blow-off is probably ludicrous, and probably why you shouldn't be trading, because it's a blow-off. So your action is going to be more watching that carefully and determining how many pips you're willing to have a retracement take before you get out of the position. So you look at that that criteria. That's the only criteria you have. How many pips retracement will you take before you go, okay, this thing probably has run its course. Again, in Richard Dennis's case with the turtles, they'd run out 2.8 TR when it dropped 2.8 TR. Or if you go in the Donchian process, I mean, there's some really big swings there, and that's where Richard Dennis got his position risk management from, or the get out point is from the Donchian system. So you're looking at the differential. Well, you're going to look at two things. First is when price is going up way past your original take profit point, you're either looking at a gradual rise, like a trend that's establishing itself and it's going long, but it's going to have retracements, or you're going to be in a blow-off situation where the thing is just going hyperbolic on you. Those are the two cases that you have to have a rule to work with. In the case of the trend, if you can determine that it's a trend, you can probably maybe draw some trend lines and sort of use some channel analysis. Indicators are fairly good for that. You can't use indicators for trade entry, but you can use them as confluence indicators for trending price. They don't work in a chop when price trades in a range, but some of them can be valid for looking at price action in a trending environment. Since trends only happen about a third of the time, you better have some better tools at it for that. Particularly if you're in a horizontal channel, a chop situation, where price is not trending, but it's trending within this channel, but the trends are, 30 pips or 15 pips or something like that, and then you get a retracement and bounce off the channel, and then it goes back up. You have those two situations. Both of those, from a long-term standpoint, scare me, because you're not going to be able to stay awake for that whole thing. So you're going to have to rely on the only thing that you can do, which is a trailing stop. That's it. That's all you're going to be able to do. And the trailing stop really has nothing to do with the particular price action, that you have. It's a really difficult situation for the. That's easy. So I'll set a 4% trailing stop, 4% behind the low of the previous, the current candle or previous candle. You could trail it that way, or you could do it on a pip basis. But if you're looking, and that would be in a either situation, a trend, or you're following that, or you're in a hyperbolic situation in a blow-off, and you're going to go to bed and you just got this automatic trailing stop behind you. But if you're doing short-term trading on a 5-minute chart, where the ATR has gone from 5 pips to, let's say, 15, so you've got some candles that are really doing some movement, when that thing turns around, you're probably going to have a 15 pip down spike. You're going to have what's going to be a pin bar at some point. And if you look at a shorter term time frame, you'll see what they call railroad ties, which are where the one candle is going up and the other candle is going down, and they're both about the same size. That's what forms the pin bar on a higher time frame. So that downward candle is with an ATR of 15 or 20 at that point. If you wait for the close of that candle, then you are losing 15 pips. So on a 5-minute time frame where you might have gone up, your original stop is at 20 and you've gone up another 20 points, you're at 40 on your profit, and then to lose 15, that might be too severe of a hit for you. So in that instance, you have to take on watching the chart. That's why the short-term trader, you're not going to get caught in these spikes or whatever, because you're there and you can manage that. So how many pips do you want to lose? Where is that chatter going to manifest itself first? Well, if the ATR isn't too high, let's say your rising trend or your blow off or whatever, the ATR is going from an average of 5, ATR 5 on a 5-minute chart. Some of that ATR might have been, or some of those highs that have been factored into the average over the 14 periods of an ATR might be at 8 pips or 9 pips. So if you're getting candles that are that are 10 or 12 pips, then you might look on the 5-second chart, and when you see that, the thing goes up and then it comes down, and the 5 seconds starts to do this kind of stuff, and the 5-second chart might have a half a pip ATR or 1 pip ATR or something like that. When you see that 5-second chart start to do this and it's gone down 4 or 5 pips, that's when I get out. So that's the risk position risk management that I'm talking about. Again, from a day trade standpoint, is that you have to drop down in a really, really short time frame, which is where the immediate orders are being placed. And if that 5-second ATR goes from a half a pip or a pip to 3 pips, let's say, then you know that somebody's in there dumping a lot of juice down on the order flow, and that might be the time where he's cashing out his position for his client, and so that's probably the time for you to get out. If you get out, and that thing goes down another 4 or 8 pips or whatever it is, and then swings around and starts down hyperbolic up, and always get back in and grab another 5 or 10 pips with a 2-lot order. I wouldn't go in with your full lot size, because the thing at that point could start on a 20 pip ATR, not over the 14 periods, but those candles could start to become 20 pips on the 5 pip normal chart that you're looking at, and so you're gonna you could get crushed out pretty quickly. Anyway, just a thought on the management of your risk on an open position as opposed to the management of the profit target on an open position. Peter Rose, Longwood Currency Trading. Have a great day. Have a great trading day.